But once you decide to invest in stocks, you have to accept the fact that the market is volatile. The market, at some point, the market will go down. Now, whether it goes down 10% and continues going up, 20%, who knows? Nobody knows. And you have to be absolutely sure that when that happens, not if, but when, you don't panic. Because the only way you lose is if you panic and sell at the bottom.
Picture this: if Warren Buffett decides to sell his stakes in Apple and invest in Microsoft or Google instead, would you do the same? Would you say to yourself, Buffett knows something that I don't, let's follow him blindly? And because of that action, would the Apple stock plummet right after that? History has proven that when you invest in individual stocks, most of the time they gonna fall off the grace of the stock market. And this is the beauty of the S&P 500. You don't have to choose over individual stocks. By buying this ETF alone, you are literally buying the entire market. Hello, fellow investors. Welcome back to the schd channel, where we dive deep into the world of finance and explore the most lucrative investment opportunities. Today we have an exciting topic that has been the cornerstone of many successful portfolios. That is the S&P 500. Join me as we unravel its incredible performance, total return, inception, and the reason why active managed funds struggle to outperform this iconic index. The S&P 500, also known as the Standard & Poor's 500 Index Fund. It is undoubtedly one of the most well-known and widely used benchmark for measuring the performance of the U.S. stock market, consisting of 500 large cap companies across various sectors, market capitalization. But what makes the S&P 500 so special? Let's talk about performance. Over the long term, the S&P 500 has delivered remarkable results, consistently outperforming most active managed funds. In fact, numerous studies have shown that the majority of active managed funds failed to beat the market over time. But why is that, you might ask? One of the main reasons why active managed funds struggle to outperform the S&P 500 is the challenge of consistently picking stocks. It is insane that the most experienced active managers find it incredibly difficult to consistently beat the market year after year. The S&P 500, on the other hand, benefits from its diversified nature, spreading risk across multiple companies and sectors. Moreover, active funds often charge higher fees for their services, which can eat into potential returns. The S&P 500, being a passive managed index, comes with significantly lower expense ratio, allowing investors to keep more of their hard-earned money working for them. So let's discuss the inception of the S&P 500. This iconic index was first introduced March 4th, 1957, and it has become a reliable measure of the entire U.S. stock market ever since. The index's inception marked a new era for investors, providing them with benchmarks to gauge the performance of their investment accurately. Since the inception of the S&P 500 has weathered various market cycles, economic downturns, and even global crises. Despite these challenges, it has demonstrated resilience, delivering strong returns over the long term and creating wealth for countless of investors. Now, let's take a moment to appreciate the total return of the S&P 500. When we talk about the total return, we consider both capital appreciation and dividends reinvested over time. This is a crucial aspect of the S&P 500 as it showcases the power of compounding and the potential for exponential growth. The S&P 500 has shown its ability to bounce back from downturns and generate substantial wealth for long-term investors. By reinvesting dividends and staying the course, investors can benefit from the compounding effect, maximizing their returns and building significant wealth. The S&P 500 has become a reliable and robust investment vehicle, consistently outperforming any active managed funds. If you like the stock market, if you like dividend investing, if you like passive income, well, this is the channel for you. Thanks for watching. Please don't forget to subscribe, to comment, and to share, so like that, when I upload my videos, you'll get them as soon as possible. Thank you so much, and I'll see you in the next one.
Now, trust me when I tell you, when the market is taking one of its dives, it's ugly, it's painful, it's scary.